Imagine waking up one morning to find you owe HMRC £2,500 in tax you never saw coming. For thousands of pensioners across the UK, this isn't a nightmare. It's becoming reality in 2026. If you're over 65 and receiving your state pension, the next few minutes could save you from a devastating financial shock. Hello, and welcome to UK State Pension with David. I'm David, and today we're diving into a crucial issue that could affect your finances in 2026. If you're a pensioner or approaching retirement, this information is vital for your financial security. Make sure you stay until the end, because I'll share exactly what you need to do to protect yourself. So, what's actually happening here? The root of this problem lies in something most pensioners don't fully understand: the interaction between the state pension triple lock and frozen tax thresholds. Since 2010, the state pension has been protected by the triple lock guarantee, which means it increases each year by whichever is highest among inflation, average earnings growth, or 2.5%. This has been brilliant for pensioners, ensuring your state pension keeps pace with the cost of living. But here's where the problem starts. While your state pension has been rising year after year, the personal allowance, that's the amount you can earn before paying tax, has been frozen at £12,570 since 2021. The government has confirmed this freeze will continue until at least 2028. What does this mean in practice? Well, the full new state pension for 2025-26 is £11,502 per year. That's already dangerously close to the tax-free threshold, leaving you with just over £1,000 of wiggle room. Now let's look ahead to 2026. If the triple lock continues as expected and wages grow by around 3 to 4%, the state pension could rise to approximately £11,900 or even higher. Suddenly, that gap between your state pension and the tax threshold shrinks to just £600 or less. Here's where many pensioners get caught out. If you receive any additional income on top of your state pension, you could easily breach that threshold. We're talking about a modest workplace pension of just £50 a month. That's £600 a year. Interest from your savings account. Part-time work or freelance income. Rental income from a property, even certain state benefits that count as taxable income. Let me give you a real example. Margaret from Leeds receives the full state pension of £11,900 in 2026. She also has a small workplace pension that pays her £70 a month. That's £840 annually. Her total income is £12,740. That puts her £170 over the personal allowance. At the basic rate of 20% tax, she owes £34. Not terrible, right? But here's the catch. Margaret didn't realize she needed to declare this to HMRC. She wasn't registered for self-assessment. The tax went unpaid for several years. By the time HMRC catches up with her in 2026, she owes back taxes, potential penalties, and interest charges totaling over £2,500. This scenario is playing out across the country. HMRC has been ramping up enforcement using sophisticated data matching between pension providers, banks, and other financial institutions. They can now automatically detect undeclared income that previously slipped through the cracks. The £2,500 figure isn't just scaremongering. It represents roughly 3 to 4 years of unpaid tax on modest additional income, plus penalties and interest. For someone on a fixed pension income, this kind of bill can be absolutely devastating. So, why are so many pensioners getting caught? There are several reasons. First, many people assume that because their state pension is paid without tax deduction, they don't need to worry about tax at all. Second, the tax system for pensioners is genuinely confusing. Unlike employees who have tax automatically deducted through pay, pensioners often need to manage their own tax affairs. Third, if you have multiple small income sources, a bit of workplace pension here, some savings interest there, it's easy to underestimate your total income. Fourth, HMRC doesn't always communicate clearly. You might not receive a tax code notice or a reminder that you need to file a self-assessment return. What makes this particularly harsh is that we're often talking about modest amounts. These aren't wealthy tax dodgers. These are ordinary pensioners with small additional incomes who simply didn't understand the system. The frozen tax threshold has created what's called fiscal drag. As incomes rise with inflation but tax thresholds stay frozen, more and more people get pulled into the tax net or pushed into higher tax brackets without any real increase in their standard of living. For pensioners, this is especially painful because you're often on fixed incomes with limited ability to earn more. Let's talk about what you need to do right now to protect yourself. First, calculate your total income for the current tax year. Include your state pension, any workplace or private pensions, interest from savings and investments, any employment or self-employment income, rental income, and certain state benefits like carer's allowance. Be thorough, even small amounts add up. Second, compare your total income to the personal allowance of £12,570. If you're over this threshold, you need to pay tax on the excess. Third, check if you're registered for self-assessment with HMRC. If your total income exceeds the personal allowance and tax isn't being deducted at source, you probably need to complete a self-assessment tax return each year. You can register on the HMRC website or by calling their helpline. Fourth, if you've had untaxed income in previous years, don't ignore it. Contact HMRC as soon as possible. They're generally more lenient if you come forward voluntarily rather than waiting for them to find you. You might be able to arrange a payment plan if you can't afford to pay everything at once. Fifth, consider adjusting your affairs to minimize tax. This isn't about dodging tax, it's about smart planning. You might use your personal savings allowance more efficiently. Consider transferring assets to a spouse with lower income or look into tax-efficient investment options like ISAs where the interest is tax-free. Let me share another example of someone who got it right. John from Manchester realized in early 2025 that his state pension plus a small workplace pension would push him just over the tax threshold. He immediately registered for self-assessment, calculated his tax liability, and set aside money each month to pay it. When his tax bill arrived, he was prepared. No shocks, no penalties, no sleepless nights. That's the position you want to be in. Now, what about the future? The situation is likely to get worse before it gets better. With the personal allowance frozen until 2028 and the state pension continuing to rise under the triple lock, more pensioners will be dragged into the tax net each year. By 2028, it's estimated that the full state pension alone could be very close to the personal allowance, meaning almost any additional income will trigger a tax liability. There's been pressure on the government to address this. Some have called for the personal allowance to be unfrozen, or for pensioners to receive a higher allowance. Others have suggested the state pension should be exempt from tax altogether. But as of now, no changes have been announced. What can you do beyond managing your own affairs? Stay informed. Tax rules and thresholds can change, especially around budget time. Keep an eye on announcements from the Chancellor. Consider seeking professional advice. A qualified tax advisor or financial planner can review your specific circumstances and help you minimize your tax liability legally. Many offer free initial consultations. Join or follow pensioner advocacy groups. Organizations like Age UK provide valuable resources and campaign for fairer treatment of pensioners in the tax system. Here's something else to consider. If you're approaching retirement and haven't yet claimed your state pension, the timing of when you claim could affect your tax position. You can defer your state pension, and it will increase by roughly 5.8% for every year you delay. This might be worth considering if you're still working or have other income sources and want to avoid being pushed into a higher tax bracket now. Also, remember that different rules apply if you're on the old state pension system versus the new state pension introduced in 2016. The old basic state pension is lower, currently around £8,900 per year, which gives you more headroom before hitting the tax threshold. But if you have additional state pension or SERPs, that counts towards your total income too. One more crucial point. If you're married or in a civil partnership, you might be able to use the marriage allowance. This lets you transfer 10% of your personal allowance to your spouse if they earn more than you. It's not a huge saving, but every little helps when you're on a fixed income. The marriage allowance could save you up to £252 in tax. Let's address some common questions. What if I can't afford to pay the tax I owe? Contact HMRC immediately. They have payment plan options called time-to-pay arrangements. These let you spread the cost over several months or even years, depending on your circumstances. Ignoring the problem will only make it worse with penalties and interest adding up. What if I disagree with HMRC's calculation? You have the right to appeal. Make sure you have evidence to support your case, such as bank statements or pension statements. You can ask for a review or take your case to an independent tax tribunal if necessary. What happens if HMRC made the mistake? Not me. If you've been given the wrong tax code or incorrect information from HMRC, you may not have to pay all the tax they claim you owe. There's something called Extra Statutory Concession A19, which can provide relief in cases of HMRC error, but you'll need to demonstrate that you reasonably believed your tax affairs were in order. The key takeaway from all of this is simple. Don't assume your tax affairs are sorted just because you're a pensioner. The combination of rising state pensions and frozen tax thresholds is creating a perfect storm that's catching thousands of people off guard. The 2,500-pound tax adjustments we're talking about aren't hypothetical. They're happening right now to real people across the UK. The difference between those who face this shock and those who don't often comes down to awareness and preparation. Take action today. Spend an hour this week calculating your total income, checking your tax position, and registering for self-assessment if you need to. That hour could save you thousands of pounds and enormous stress down the line. If you're already over the threshold and haven't been paying tax, don't panic, but do act. The sooner you contact HMRC and sort things out, the better the outcome is likely to be. Remember, paying the right amount of tax is important, but so is not paying more than you should. Make sure you're claiming all the allowances and reliefs you're entitled to. And if you're unsure about anything, seek professional advice. It's almost always cheaper to pay for an hour of a tax advisor's time than to deal with the consequences of getting it wrong. Thank you so much for watching UK State Pension with David. I hope this has given you the information and motivation you need to protect yourself from unexpected tax bills. Your financial security in retirement is too important to leave to chance. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more essential pension and retirement information. Share this with any pensioners you know who might be at risk. Together, we can make sure fewer people face these nasty surprises. I'm David, and I'll see you in the next video. Take care and stay financially secure.